This is a quick revision video containing key points of 5 theory topics from AFM subject, and the 5 topics are startup finance, security analysis, financial policy and corporate strategy, risk management and securitization. First, coming to the startup finance chapter. Startup conditions or criteria: up to 10 years of incorporation, turnover not exceed 100 crores, working towards innovation, development of products or services. Startup not startup if formed by splitting up or reconstruction of existing business. Next, sources of funding startup: personal financing or personal credit lines, family and friends, peer-to-peer lending, lend money to each other, crowdfunding, small capital from large number of individuals, microloans, low interest rates, vendor financing, in simple language vendor defers payment terms, purchase order financing, advance funds to supplier, factoring accounts receivable, goods that are sold on credit. Pitch presentation: short and brief summary explaining investors about why they should invest in company, face-to-face or online meetings. Points to be kept in mind: introduction, team, problem, solution, marketing and sales, market size communicated, projections or milestones, balance sheet, cash flow statement, income statement, competition. Business model, business process or target customers, financing, money raised or invested. Unicorn features: privately held startup, valuation reaches $1 billion, valuation less than $1 billion then lose unicorn status. In Mobi, first unicorn in India, Decacorn valuation more than 10 billion US dollars. Bootstrapping: build a company from personal finances or operating revenue. Methods: trade credit, prepare well-crafted financial plan to convince supplier. Factoring: trade receivables sold to commercial finance company to raise capital. Lease: equipment taken on lease rather than purchasing. Angel investors: invest in small startups, one-time investment, more favorable terms. It is opposite to venture capitalist, and angel investors are also called as informal investors, angel funders, seed investors, etc. Entity that provide fund may be company, business, trust or investment fund. Venture capital fund: manage funds to invest in startups. Venture capitalist: finance rapidly growing new company, purchase equity, add value through active participation. Characteristics: long-term horizon 3 years to 10 years, lack of liquidity, high risk and high return, equity participation. Advantages: long-term equity finance, share both risk and rewards, provide practical advice and assistance, network of contacts that add value, additional rounds of funding, preparing company for IPO, facilitate trade sale. Stages: risk is different in each stage, indicative risk matrix of each stage. Stage: funds locked in, risk perception and equity to be financed. Seed money, 7 to 10 years it is locked in and has extreme risk perception, and equity to be financed is supporting an idea. Startup, 5 to 9 years, very high risk perception, it is for initiating prototype operations. First round, 3 to 7 years, high risk perception, equity to be financed as commercial production or marketing. Second round, 3 to 5 years, sufficiently high risk perception, working capital needs. Third round, 1 to 3 years, risk perception is medium and equity to be financed are market expansion, product development, which is mezzanine financing. Fourth round, 1 to 3 years, risk perception is low and it is for public issue, which is bridge financing. Venture capital investment process: the first step is deal origination. Investment memorandum is given by company which contains business plan, financial plan and then exit plan. Sent for screening. To select company for further processing. Due diligence, venture capitalists verify veracity of documents. Deal structuring, structured that both parties win. Convertible structure, promoter retains right to buyback. Tag along clause, venture capitalist put condition that promoter also sell his stake. Post investment activity, venture capitalist nominate nominee. Exit plan, spell out at the time of investing 2 stages of exit plan. Sell to third party, promoter give buyback commitment at pre-agreed rate. Structure in India, domestic structure, domestic vehicle for pooling of funds. Entity is either trust or company. Separate investment advisor. Offshore funds, offshore structure, investment directly into Indian company managed by offshore manager. Next, unified structure, domestic investor participate and directly contribute to trust. Overseas investor pool assets in offshore vehicle. Why India became sustainable environment for startups. Pool of talent, cost effective workforce, increasing use of internet, technology, variety of funding options. Succession planning in India, meaning identifying critical positions and developing action plans, ensures right people are available for right job, promote all employees not just who are at management or executive levels. Need for succession, risk mitigation, cause removal, talent pipeline, conflict resolution mechanism aligning. Business strategy, evaluate key leadership positions, map competencies required, identify competencies, bridge leader. Challenges, founder mindset is different, premature for startups, in absence of founders succession planning is difficult. End of this chapter. Next chapter, security analysis. Fundamental analysis, assumptions. Share price depends on future dividends. Economic analysis, factors affecting growth rates like national income and industrial sector, inflation or monsoon. Techniques used or indicators used to assess anticipatory survey, barometer or indicator approach, leading, lagging, roughly coincidental or roughly coincidental, economic model building approach. Industry analysis, factors, product life cycle, demand supply gap, barriers to entry, government attitude. Techniques used, regression analysis, input output analysis. Now coming to company analysis, factors, net worth or book value, sources and uses of funds, growth record, financial analysis. Techniques used, decision tree analysis, trend analysis, correlation and regression analysis. Next coming to technical analysis, share price movement based on graphs or charts. Principles. Principles are market discounts everything, price moves in trends, history repeats itself. It has 3 theories, one is Dow Jones, another is Elliott wave theory and then random walk theory. Coming to Dow Jones theory, originated by Charles Dow, determine relative strength of stock market, 2 indices DJIA and DJTA, movement of market, primary, secondary or daily fluctuations. Coming to Elliott wave theory, formulated by Ralph Elliott, analysis of 75 years of stock price movements, defines price movements in terms of waves. It has 2 parts, impulsive patterns and then corrective patterns. Random walk theory, behavior of stock price is unpredictable, not predict future price trends represent past data. Coming to market indicators, breadth index, divide net advances or declines in market by number of issues traded, supports or contradicts Dow Jones average. Volume of transactions reflects how market behaves in near future. Confidence index, example loans. Relative strength analysis, some securities rise faster in bull market or decline slowly in bear market. Odd lot theory, assumption average person is wrong, pursue strategies contrary to popular opinion. Evaluation. In efficient market, technical analysis may not work well. With imperfections, technical analysis may be helpful. Arguments supporting it are identify trends early, detecting shift in demand and supply. Against it are the arguments against it are not able to provide convincing explanation for tools, evidence in support of random walk hypothesis. Efficient market theory or hypothesis developed by Eugene Fama. All price sensitive information is reflected in market and impossible to outperform market. Coming to the misconceptions. It is not possible for investor to achieve superior investment performance. Price cannot reflect fair value. Random movements suggest stock market is irrational. Level of market efficiency. Weak form reflects past prices. Semi-strong market reflects past prices plus public available information. Strong market reflects past prices plus public available information plus private information. Weak market has three types of tests. One is serial correlation test. Price change in one period is corrected with price change in some other period. Run test. Analyze sequence of daily price changes by counting number of runs. Determine whether statistically different. Filter rules test. Buy or sell when price crosses n percentage threshold. If behavior of stock price changes is random, test rule strategy should not be applied. Now coming to challenges. Information inadequacy, limited information processing capabilities, irrational behavior and monopolistic influence. End of this chapter. Financial policy and corporate strategy. Advanced role of CFO including value creation, leadership role. Traditionally, main role is wealth maximization. In current scenario, role expanded in following areas like risk management, supply chain, mergers and acquisition and corporate restructuring, ESG financing. Strategic financial decision making framework. Three fundamentals of business: strategy, finance and then management. Financial strategy, key decisions or key financial decisions such as financing decisions, portfolio decisions, investment decisions and then the dividend decisions. Strategy at different hierarchy levels. Corporate level strategy, select business to compete, answer basic questions like suitability, feasibility and acceptability. Business unit level strategy, coordination of operating units. Functional level strategy, functional business process and value chain, development of resources in operating department. Through business unit level strategies, through business unit level strategies can be executed effectively and efficiently. Financial planning, approach to maximize financial resources by utilizing financial tools to achieve financial goals. Components are financial resources, financial tools and then financial goals. Outcomes, financial objectives consistent with corporate mission, financial decision making, analyze financial problems, financial measures, ratio analysis, cash flow statement to analyze the performance or evaluate the performance. Interface of financial policy and strategic management. Starting point and end point of an organization is money. Sources of finance and capital structure. Strategic plan dimensions are the strategic plan dimensions, and another important aspect of these dimensions are investment and fund allocation decisions, dividend decisions affecting strategic performance of company. Financial policy cannot be worked out in isolation. Sustainable growth, balancing financial goals vis-a-vis sustainable growth, helpful for healthy corporate growth, sales growth goals consistent with operating and financial policies. If they are not consistent, then conflicts arise. Important in long-term development, sustainable growth is important in long-term development. Too fast or too slow growth goes against the organization. Adopt financial policy to make enterprise growth speed close to sustainable growth rate. Sustainable growth rate. At given level of profit, maximum growth achieved in sales. Grow without borrowing money. Sustainable growth rate is equal to ROE into 1 minus dividend payout ratio. It assumes business wants to maintain a target capital structure or a target dividend payment ratio and increase sales. Organization sustainable. Clear strategic direction, adequate administrative and financial infrastructure, identify opportunities, competent staff, community support. Organization sustainable financially. More than one source of income, more than one way of generating income, adequate financial systems, good public image, and then financial autonomy. End of this chapter. Now coming to next chapter, which is risk management. Types of risk. Strategic risk, strategy less effective, compliance risk, not comply rules and regulations, operational risk, internal risk, failure to cope with day-to-day operational problems, financial risk, unexpected changes in financial conditions like prices, financial risk evaluation, different point of views, stakeholders point of view, financial gearing, company point of view, company borrows excessively, government point of view, failure of any bank. VAR, value at risk, means measure of risk of investment, how much an investment might lose in a set of period. Features, components of calculations, time period, confidence level, and loss in percentage or amount. Statistical method based on standard deviation. Time horizon, probability of maximum loss, risk control, set limits, maximum loss, z-score, standard deviations, the number of standard deviations away from mean, applications or significance, maximum possible loss, fixed limits, enable to decide trading strategies, performance measurement, benchmark, assets and liability management tools. Methods for identification of management of financial risk, classification of financial risk. First one, counterparty risk, non-honoring of obligations by counterparty or credit risk. Assessment or identification, failure to obtain resources to complete transactions, regulatory restrictions, hostile action of foreign government, let down by third party, become insolvent. Management or mitigation, carry out due diligence, not overcommit, know your exposure limits, review credit limits, defaults, rapid action, performance guarantee. Next one, political risk or country risk, faced by overseas investor, adverse action by government of host country, assessment or identification, confiscation of overseas property, rationing of remittance to home country, restriction, conversion of currency or borrowings, price control of products. Organization to make investment, assess political ranking, macroeconomic conditions, popularity of current government, advices from embassies. Management or mitigation, local sourcing of raw material, entering joint venture, local financing, prior negotiations. Interest rate, next one is interest rate risk. Change in interest rate results in change in assets or liabilities. Assessment or identification, government monetary policy, demonetization, economic growth, investment by foreign investors, stock market changes. Management or mitigation, forward rate agreement, asset and liability management, interest rate futures, interest rate options, interest rate guarantees and interest rate swaps. Currency risk, cash flow changes with movement in currency exchange rate. Assessment or identification, government action, nominal interest rates, natural calamities, war, coup, rebellion, change of government. Management or mitigation, low risk, low reward, automatic hedging. Low risk, reasonable reward, selective hedging. High risk, low reward, unhedged. High risk, high reward, active currency trading. End of this chapter. The last topic, securitization. Securitization means repackaging illiquid assets into marketable securities. Features: creation of financial instruments, additional financial product, bundling and unbundling, broken into fixed denomination. I'm repeating this again. Bundling and unbundling. Bundling means combined in the pool, unbundling means broken into fixed denomination. Tool of risk management. Default risk is shifted. Structured finance, meet risk return trade. Trenching, split into parts based on risk and return. Homogeneity, homogeneous in nature. Benefits from angle of originator: off balance sheet finance, specialization in main business, improve financial ratios, reduce borrowing cost. Benefits from angle of investor: diversification of risk, regulatory requirements, protection against default. Participants in securitization: primary participants, main parties, originator, initiator or securitizer, sells assets in books of accounts and receive funds. Special purpose vehicle: this originator transfers rights in assets and this special purpose vehicle is created for securitization. Investors: buyers of securitized papers. Secondary participants: obligors, assets in balance sheets owe money to firm. Rating agency, credit quality. RPA, receiving and paying agent, who is like an administrator, collects and pass to SPV. Agents or trustee takes care of interest of investors. Credit enhancer in and additional comfort in form of collateral, surety of bonds, etc. Structurer, investment banker, arranger of deal. Steps in securitization: creation of pool of assets backed by similar mortgage, assets transfer to special purpose vehicle. SPV, special purpose vehicle, repay funds from pool of assets. Sale of securitized papers based on pool of assets, example, pass through certificate and pay through securities. Before sale, credit rating is done to assess the risk. Administrator of securities collects principal and interest. Recourse to originator on default. Reasons for dismal growth or problems in securitization: popular off balance sheet source of financing, growth is far behind. Main problems: stamp duty up to 12%, taxation, taxed in representative capacity or investors are taxed, accounting problem if transferred without recourse, lack of standardization, originator own format for documentation, inadequate debt market, lack of existence, ineffective foreclosure laws, not supportive to lending institutions. Securitization instruments: pass through certificate, transfer entire receipt of cash or direct claim of investors on all assets securitized, pay through security, special purpose SPV debt, special purpose vehicle debt backed by assets, tranches from varying maturities, SPV to reinvest surplus funds due to desynchronization. Stripped securities: divide cash flows into two new securities, interest only securities or principal only securities. Interest only securities, holder receives interest, principal only securities, holder receives principal. Yield to maturity rises, principal only security falls and interest only security goes up. Pricing of securitized instruments: acceptable to both originator and investor. It is the pricing is of two categories: originator's angle, rate at which originator has to incur outflow; investor angle, by discounting best estimate of expected cash flows using yield to maturity rate. Securitization risk: credit or counterparty risk, risk of bankruptcy and non-performance of service. Legal risk: absence of statutory provisions, dispute over ownership, uncertainty of investor payouts. Market risk, macroeconomic risk. Market risk, I'm repeating this again. Performance of underlying loan contracts depends on macroeconomic risk. Prepayment risk. Interest rate falls, which means prepayment of loans increases. Investors reinvestment risk also has investors reinvestment risk. Interest rate risk, it pools floating rate and investor payout, which is fixed rate, or vice versa, results in interest rate mismatch. Pool cash inflow may not be equal to investors payout. Tokenization, converting tangible or intangible assets into blockchain tokens, attempts to convert illiquid assets into liquid products. Similarities with securitization, liquidity diversification trading, or new opportunities. Blockchain, DTL, distributed ledger technology. It is shared, decentralized, open ledger of transactions. Every entry is permanent. Applications, financial services, healthcare, government, travel industry, economic forecasts. Risk, who is responsible and how accountability is achieved. If underlying technology is tampered, render financial information to be inaccurate and unreliable. In absence of central authority, challenge in control activities to develop and maintain. Risk of information overload, challenges level of monitoring required. End of theory chapters. Thank you.